So here's what would happen if the Fed cuts deep and fast today. Interest rates going down means it's easier to borrow money, so there will be more cash in the system. This would boost the economy, and the stock market would go up as investors move toward riskier assets. In the best-case scenario, when the Fed overnight rate goes closer to 0%, the 10- and 30-year treasuries will follow and go substantially down. This would help the government lower a big part of the deficit. For example, so far this fiscal year, the government has spent $749 billion in interest on the debt. This is the second largest government spending, and it accounts for 56% of the yearly deficit. So doing a deep cut in interest rates could, in theory, give a better balance sheet to the U.S. government, which in turn would improve its credit rating and make treasury yields actually lower. However, there could be a massive downside. Inflation is currently trending back up, and the full impact of the tariff is not here yet, which means inflation will likely keep going up in the next few months. If the Fed were to aggressively cut, this would stimulate inflation even more, which would force the Fed to raise the rates again, while the 10- and 30-year treasury yields are also rising. This would put the U.S. government in a difficult position with higher inflation, higher budget interest, so higher deficit. In short, cutting interest rates deep and fast is a real gamble, which is why most of the Fed members would rather wait a few more months to see the impact of tariffs on inflation. You think they should cut soon?